I'm Morella Fernandez. Thanks for joining us today on Market Call. Brianne Gardner on the show with us. She's Senior Wealth Manager, Velocity Investment Partners, Raymond James. She'll take your questions today on Canadian and U.S. large caps. Here's how to reach us. 1-855-326-6266. If you would like to phone in, you can also email your questions. Market Call at bnnbloomberg.ca. Brianne, thanks for joining us. Good to see you.
Yeah, thanks for having me.
So you see North American markets as entering a new chapter. Have we turned the corner away from tariff concerns?
Yeah, I think headlines have certainly shifted a lot from tariffs now. The focus is really on rate cuts and the path forward. I think the Federal Reserve and the Bank of Canada have delivered interest rate cuts to kick off almost that renewed cycle, really after months of anticipation, especially out of the U.S. after they were on a 9-month pause. So the immediate reaction was out of investors initially mixed in markets, but that was not really a surprise for us either. I think equities often do pause after policy changes as investors are really recalibrating what the path and the pace of this easing is going to be. So for us, the mid-September softness that we did see didn't really last long. You saw investors come back in looking at buying the dip on that short little pullback. And really, we still believe we could see a bigger pullback from the all-time highs, though we do not expect to see a break in this upward trend. I do think that leadership has narrowed slightly as tech and media giants are still taking and leading the charge, with utilities and consumer discretionary following close behind.
Okay, so where are you seeing money flow these days?
Yeah, I think, Canada and the U.S., you have seen a little bit of mix. I mean, in Canada, the leadership setup is similar, but I think we say with a TSX twist. So financials and materials continue to anchor performance out of the TSX, obviously supported by gold prices that we have seen kind of level out, and really optimism on the economy. I think bank stocks are climbing. We're seeing that across the board as really credit quality remains manageable. So we are still bullish on financials for sure, I think, but net interest margins are compressing. Real estate as well. Names are really digesting the higher costs of capital and mortgage resets. I think you're seeing that a lot across headlines now in the media and the news of the amount of people up for mortgage renewals or looking at their options there. And then industrials, another sector, are lagging there. So we're seeing, they're waiting for, I think, clear outlook really with that trade and economic growth that you mentioned earlier. So for us, we are being a little bit active, but constructive.
All right, Brianne, we are going to take a quick break. We'll line up some phone calls and some emails for Brianne Gardner of Velocity Investment Partners, Raymond James. She's going to take your questions today on Canadian and American large caps. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. Brianne Gardner with us as our guest, and she is going to take your questions. The first one comes from Shelley in an email. Shelley writes, what does Brianne think of Canadian Tire? Brianne, Canadian Tire, very well-known brand. I know they've been trying to make some changes, do some renovations. They've made changes to their loyalty program, points program as well. What's your overall view of Canadian Tire?
Yeah, and great additions there. I think we don't own Canadian Tire specifically in our portfolio. We hold Couche-Tard instead, I think directly for similar consumer retail exposure, as we would like to say. In that space, though, and even specifically with Canadian Tire, as you mentioned, they have announced that strategic loyalty partnership with Tim Hortons. I believe that was not too long ago, middle of September, linking that Triangle rewards to the Tim rewards. And that kind of lets customers earn additional Canadian Tire money as well. So that, that is a big step in the right way there. Beating estimates we saw last time there on their earnings, which is great. I think they have still a deep national brand, diverse banners, and really growing loyalty ecosystem. something I would say a little bit concerning or something we would be cautious of is their exposure to big ticket, especially in the consumer cycle space, and macro pressures on discretionary spends and tariffs. So I still see, they're doing a great job with this partnership, loyalty upgrades, and store digital refresh initiatives. Analysts ranking about a hold on the street, 175 target, so still about 6% upside from here.
Okay, good to know. Hope that helps Shelley out as we move to John from London with a question. Hi, John.
Marilla. Hello, Brianne. Brianne, I thought it might be interesting to contrast the more conservative side of my portfolio with Pembina Pipeline and then the high-end glitzy end, Nvidia. Now, both have started to do well in the last week or two, as you predicted about Pembina. What should I add to at this point? I would appreciate your 2 ratings out of 10 for the 2 stocks. Thank you.
Thanks for the question. Nvidia, by the way, is at 186.37, so it is hitting a record high today. We talked about a pullback on stock about a month ago now, but you still think there could be strength here?
Yeah, in Nvidia, yes, it is a stock that we do own in the portfolio. We own almost a 4% weight. We still see there's more upside. Fundamentally, the stock still ranks a 9 out of 10 for us. Value a little bit lower. Analysts on the street are saying potentially price target upside still over 17%, looking around that 214 price target. I think, again, Q2 earnings, we saw reported record revenue out of the business over, I think it was 46 billion, up 56% year over year, still dominating. And then partnering with ChatGPT, the OpenAI, $100 billion. So, they are continuously being leaders. I think they're dominating and still dominant in the AI chip market and high margins with the CPU fuels, that robust growth for them. So yes, their high valuation is still there. But do we still see room to run for the stock? Yes, we would be a little bit tactical if you are looking for an entry point rather than maybe getting in all right now.
Okay.
And then
Sorry to interrupt you. I just wanted to know whether you had any concerns about Huawei in China overtaking the market that once was Nvidia's, but Nvidia has been hindered, of course, by American policy.
Yeah, I think there's always going to be competitors, and I think Nvidia did a great job at getting into the market initially very quickly and engaging with their consumers, and I think they've done a good job at building up that. So for us, I think we still favor Nvidia. Yes, there's going to become, and I think more and more competition on the street, but the important thing is knowing when to take profits off the table, continue to trim up your positions as they do get larger, right? Like we've had Nvidia run to 7%, trimmed it back to 3.5%, ran up again. So I do think it needs to be an actively managed position in the portfolio.
Okay, good to know. Let's move on to Melvin, who is on the line in Toronto. Hi, Melvin.
Hi.
Go ahead.
Okay. My question is, I'm thinking of buying the relatively new BMO Gold Bullion ETF fund, but I'm worried about whether gold has reached its maximum, and if there's any upside for gold at all. And secondly, I'm interested in Wheaton Precious Metals as a stock, and I'd like your opinion on both those matters.
Okay, thank you for the question. Are you good with an ETF question, the BMO ETF, Brianne?
I don't know the ticker off the top of my head. I can start with Wheaton Precious Metals. If you want me to circle back to that, I can as well. I'm still generally overall still bullish on gold. We still own gold overall. We do own through ETFs. That is, if you are getting bullion, I do think that's the way to go. Looking for, there is a range of ETFs you can get on the market. With regards to Wheaton Precious Metal, that is another way we do get exposure to, the precious metal space. And we believe that them as a streaming company and with a quality portfolio is really the way to go as well. Is a position we do own in our portfolio, ranks a 9 out of 10 fundamentally. I mean, even if you look over the past year to date, stock has been on a great upward trend consistently, hasn't broken down at all. Yes, maybe a little bit more limited upside from here, but has been consistent. So is one that we continue to hold at this time.
Okay, let's move on to an email from Dawn. Dawn says, is now a good time to step into George Weston stock as it has come down recently Or with all the uncertainty around us, will there be an even better opportunity later in the year? That is a question from Don. We'll pull up the stock chart and have a look at that, see how much of it is off. Is this a stock that you follow at all, Brianne?
Yeah, George, it's not one that we do own in our portfolio. I would say like we own Dollarama, for example, for comparable in the consumer staple space. Right, George Weston, again, in that kind of consumer staple food retail. They're in the food processing and distribution of fresh and frozen baked good, operating through, Loblaws, Choice Properties, etc. 6 out of 10 from a value score and 7 out of 10 from a fundamental. I think we saw Loblaws revenue up 1.5% up to that 13.9 billion, earnings per share beat forecast. There's still a dominant grocery market share that continuously drives their consistent revenue. Some risks we would say for the stock, some negative publicity over pricing can definitely hurt brand trust, and we did see a little bit of that, and some regulatory oversight and competitors can certainly limit that profitability. You're still seeing a buy on the street around the 97% target, so about 16% upside from where it's trading at around today.
You mentioned that sometimes brand loyalty becomes an issue depending on what's going on, but what was the reason? Was there an obvious reason for that big drop-off?
I don't know the exact news that came out around it, but I do know that it was related to some negative publicity that they did have over pricing, and same thing. As you mentioned, any brand loyalty, any pricing power, anything like that can certainly deter loyal consumers from a brand. Loyalty is certainly earned. And when customers feel like you've broken that trust or broken that loyalty, they will certainly pivot to competitors.
All right, Brianne Gardner with us of Velocity Investment Partners. We will line up more of your phone calls and your emails for after the break. Stay tuned. Welcome back, and thanks for joining us. Let's go to Peter on the line in Niagara Falls. He's got a question for Brianne Gardner. Hi, Peter.
Hi, good afternoon, ladies. My question for Brianne is on Scotiabank. From all the metrics that I see, it still seems like one of the cheapest Canadian banks. I just noticed the relative strength has gone over 80, which is a good sign. What's your opinion? I'll hang up and listen to your answer. Thank you.
Okay, thanks for the question, Brianne. With the comparison of the banks, what do you think of Scotia?
Yeah, Scotia, still ranks a value 9 out of 10 for us, from a fundamental 6 out of 10. If we're looking in comparison to TD up year to date 50%, Bank of Montreal up 35%, Bank of Nova Scotia up 22%. So we certainly are looking at long-term returns too. I think even if you're looking over the last 20 years, you've seen Royal and National Bank be the top two performers. That can certainly get a little bit closer over time. But for us, we don't own Scotia in the portfolio. We instead own Royal if we're going to do a comparable there. I think still, though, Scotia is leading Canadian international bank. I think if you own the stock instead of Royal, you have seen Royal again have a nice strong performance year to date. So maybe Scotia is going to turn around and do a little bit of a catch up there. We did see major headlines, I think, decreased in its Canadian dollar prime lending to that 4.7 from 4.95. That was end of September. So again, in line with Bank of Canada's cut. So keeping very competitive with mortgage rate renewals. And I do think they have extensive international footprint in Latin America and the Caribbean. So for us, it continues to be an investor, and they do, in technology, their digital platform, and their Q2 earnings showed steady loan growth and stable credit quality. So if you still own this stock, I'd be a holder. Again, we own Royal instead.
Got that. All right, let's go to Chris on the line in Victoria, BC. Hi, Chris.
Oh, good morning, Morella and Brianne. Great to have you back on the show. Brianne, I'd like to ask you about Sienna Senior Living. It's not a stock that I own. I've owned Chartwell for about 4 years now and have done very well with it. And I'm wondering if the 5% dividend yield with Sienna, given the move, is still attractive. I'm a long-term investor, 5-year plus, well, really even 20-year plus time horizon potentially, I'll hang up and listen. Thank you.
Thank you for the question. Sienna Living Long-Term Care Services, of course, which will be a growing need in the coming years. What do you think of Sienna?
Yeah, certainly. I agree. I don't think senior care is going anywhere. Aging demographic, whether, homes are becoming more and more popular for seniors. And I think even they have done a good job. I do like Chartwell over Sienna personally, as the caller had mentioned. From a value score, Sienna ranks a 7 out of 10, fundamental a 5 out of 10. I do think, the dividend of 5% at this point, again, I think it could be stable. I think they run still both the retirement residencies, which is that independent living, assisted living, and long-term care, which is great, rather than just one or the other. And they have really a diversified geographic presence. They're in kind of across Canada. We have Ontario, BC, Saskatchewan. So, they are operating in multiple markets, and they do pay that regular dividend, that 5%, and they're constantly adding new properties. So I don't see any issues at this point of them cutting that dividend right now.
Good to know. Okay, we hope that helps them out as we move on to Daniel, who's calling from Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, Brianne. Great host and one of the best guests as usual. And my question is on Hammond Power. Is it on your watch list? And if so, can you recommend an entry point for a starting position as well as any scorecards? Thanks for taking my call.
Okay, thank you for the question. Brianne, is this one you watch, Hammond Power?
So I don't own Hammond Power. We own, I would say, Capital Power, for that direct exposure into the kind of power infrastructure renewables space. But even if I'm looking at Hammond Power in the charts there too, fundamentally it's actually checking off a 9 out of 10 for us. A little bit more on the value, that 4 out of 10. But if analysts on the street look to have, I think, a price target of that 152, so you're kind of 24% upside from here. I think, they do design and manufacture custom transformers and power solutions for industries like the renewables, mining, EV charging. And still in 2025, the TSX 30 ranking in the top performing companies, which is great to see that growth. Q2 results reported record revenue, $224 million, up 14% year over year. Gross profit margins dipped 30% due to input costs, though. Could be vulnerable to rising raw material costs, obviously impacting their margins and supply chains disruptions that could delay some projects. But still leadership in that custom transformers with a global manufacturing footprint in North America and India being an expanding market there. So again, I see the space has demand for AI computing power demands that the company could likely do well.
Brianne, we are going to leave it there for this block. We are taking a quick break. When we come back, a look at Brianne's past picks. Back in a moment. Time now to take a look at Brianne Gardner's past picks. These are from November 5th of last year, Brianne. At the time, you picked Thermo Fisher Scientific. At that point, it was at $560 US. It is down to $460.24 today. So it's an 18% return drop and a total return drop of the same. What's been going on with the company? Did you sort of hold on to the stock or did you lose some of it?
Actually, we did add some more on the dip. So we averaged out at 402 in June. So now we're down about 4% for clients. Again, usually we will look at doing some active trading like that, which I think is, now we only have that 4% to climb to get back to positive. I still think TMO or Thermo Fisher is still one of the go-to names in the life science and supply labs and drug maker with everything from from testing to pharma services. And I think after, yes, a few slow quarters, they had been struggling a little bit, the company is starting to regain its stride, which is positive momentum that we are seeing. I think the demand from biopharma and research labs is improving, giving its core business a healthier outlook. I think the pharma services are a bright spot, and I think strong backlogs and smoother execution are really a key growth engine that, given their higher margins are there, is going to be profitable. So for us, the stock trades below its long-term average, giving investors really a way to tap into the healthcare innovation, diagnostics, and research through this next cycle. 8 out of 10 fundamentally for us, with 19% upside from here.
Was it the Donald Trump and Washington sort of pull on research spending, for example, that hit the stock?
Yeah, I mean, you did see a lot with Donald Trump coming up and, making healthcare a little bit more affordable as well, especially out of the U.S. I do think that, TMO got dragged down a little bit with that as well. And they still have, again, strong momentum, have still been doing both strategic business expansions and are still on analysts' favorable ratings. So, a short-term blip we saw in the stock looked as an opportunity for us to add to a great company that we see long-term upside on.
Okay, let's get to your next past pick, which is Coca-Cola, KO on the New York Stock Exchange. Now, at the time you picked it, it was 65.37 U.S. It is up to 66.09 today, so a 1% return, a 4% total return. Is this a company you still own, you still like moving forward?
Yeah, Coca-Cola staple. Majority of people all know Coca-Cola. We believe that it's still really the gold standard of beverages. I think 200 brands they have in their portfolio and global reach over 200 countries. I think the story is steady execution, right? They have organic revenue grew 5% last quarter. Unit volumes are now improving again, and even tough macro environments like Asia are all starting to get better. I think Coca-Cola will and continues to have pricing power, and they've been able to really raise their prices without losing their loyal customers, especially in emerging markets where volumes are now rebounding. So for us, they have margins are resilient. They're up nearly 160 basis points year over year. The company is expected to grow their earnings per share around 7 and 9% in 2025, and at about 22 times forward earnings, you're getting a stable compounding company with a 3% yield of long history of navigating inflation, recession, and rate cycles. So for us, ranks a 9 out of 10 fundamentally, and we see about 19% upside from here as well.
All right, if people want to hold on to that, let's get to your last past pick from November last year. CES Energy Solution, CEU on the TSX, 8.17 at the time you recommended it, now to 9.23, so 13% upside, 15%. Total return. They do sort of a little bit of everything: fluids drilling, wastewater management. They have their fingers in lots of different pies.
Yeah, and what's really impressive about this company is how well they've held their margins. Even with the volatile energy prices we've seen, CES has delivered 27% EBITDA margins, proof of really their strong pricing discipline and execution. I think the U.S. side of their business is really the real engine. They're now close to 70% of their revenue, and as big, shale players keep choosing CSE for its tech and service edge, will continue to push their profitability and stock price up. So financially, they're in a sweet spot. We see their net debt is under 1 times EBITDA, leaving room for buybacks, which would be great, and a dividend yield that is about 1.9%. So with the stock trading at just 5 times EV to EBITDA, valuations are still looking very attractive for a company delivering at these levels. So for us, we see about 12% upside still in the stock, so double digits, and ranks an 8 out of 10 fundamentally for us. And you're still seeing earnings growth 1 year, 3 year, and 5 year, all in that double digits, 30%, 60%, and 50%. So for us, it's still a hold for us.
All right, we are going to take a quick break. We'll line up some more phone calls and some emails for Brianne Gardner. We're back in a moment. Welcome back. Let's go to the phone lines. Mark on the line from Markham, Ontario. He's been holding there. Hi, Mark.
Hi there. My question is on UnitedHealth. Do you guys still own it? I know you previously recommended. Do you still own it? And where do you see it going from here? Thanks.
Okay, thank you for the question. So I pulled up the chart here, and I noticed it has been coming back since, I guess, start of September. It's done some growing here, started moving sideways a little bit after that, but it's up more than 10%. Do you have faith that UnitedHealth is going to claw its way back?
You know, we saw a little bit of that relief rally, I think, too, after, a little bit of a spike up when Warren Buffett came and disclosed his exposure or holding in UnitedHealth. For us, we did sell our position. We sold some of it ahead of that in our for a tax loss. And then once we've seen a recovery, when we got to profitability levels, we sold out of it. Again, the first time, sure, admittedly exited a little early, but at the time we saw mounting headwinds for the company and decided to kind of redeploy that capital elsewhere. And the new position we have bought has done well. I think there's still, the horrible thing or the sad thing about UnitedHealth is they're still like the largest private health insurer in the U.S. And again, when Berkshire Hathaway disclosed they have, I think it was $1.6 billion stake, that kind of drew in that renewed attention back to UNH. But we saw their shares drop again after earnings miss and guidance cut. So for us, when you start seeing too much negative attraction to a stock, I think also driven by higher medical costs and regulatory scrutiny, there's still a lot of buildup on regulatory and the probes that they're doing and leadership changes had added too much uncertainty for us that we decided to cut our losses and pivot out of that one. So again, a stock that we're staying away from at this time.
Okay, good to know. Let's go to Ed, who is on the line in St. Catharines, Ontario. Hi, Ed.
Oh, hi. My name's Dave.
Oh, I'm sorry. I have the wrong caller. Go ahead, Dave.
Oh, no problem. I was wondering about Propel Holdings. I'm down about 4%, and I'm just wondering whether it's reaching a bottom and starting to come back up, or whether I should jump ship. Thank you very much for your input. Bye-bye.
Okay, thank you for the question. So Propel Holdings at $29.43. It's down almost 4% on the day. Had that big dip in April like everybody else, and then it's kind of a little down sideways.
Yeah, Propel is not a stock that we do own in our portfolio. They're seeing a value score for us would rank a 7 out of 10, fundamentally out of 8 out of 10, between a buy and outperform of analysts on the street. So they still see about almost 44% upside from here. Pretty volatile stock if you look at me. I think, they are Toronto-based fintech company, focused more on that credit inclusion. They operate online lending platforms for lenders. They did an acquisition at Quid Market, a fast-growing UK consumer recently. Their revenue was up 42% to $450 million, and net income up 67%. So, if you're only down 4% on this position, I believe that's what he mentioned, I would continue to hold this stock and kind of ride it out. I think you could see, a niche advantage in lending to underserved consumers. I think a strong tech platform expanding into new markets, into the UK, and new acquisitions could drive material earnings growth. Yes, there's still issues with non-prime borrowers are a little bit riskier lending, and economic uncertainty could spike defaults. But if I own this stock, I would be just a holder of that.
All right, we hope that helps out Dave as we move on to Rose, who's calling from Cambridge, Ontario. Rose, what's your question?
Hi, Brianne. Is there a stock in the REIT sector that you would buy today, a stock that's not in the retirement housing sector? I'm just wondering if there's a REIT that ticks many of your boxes. Thank you very much.
Thanks for the question. Is there something outside of senior care that you like in the REIT space?
Two stocks I think I would say that we like are Granite REIT and Canadian Apartment REITs are in like the real estate investment trust. I think Granite for us gives us growth focused on the industrial and logical properties, riding kind of that e-commerce and supply chain wave. Canadian apartment REITs gives us stability. We believe it's apartments and rental housing with still strong demand and steady rent growth. So I think both play a little bit of a different role, but if I had to pick one favorite today, I think I would lean towards Granite REIT because of the growth runway in really the logistics and industrial real estate space. I do see with interest rates moving lower, we expect REITs to benefit from really cheaper financing costs and improve investor appetite for yield.
All right, we hope that is good for Rose. Let's move on to William from London with a question. Hi, William.
Good afternoon. I've had Amazon for quite a long time. I'm wondering if I should buy more, and how would you suggest I should value it?
Okay, thank you for the question. I'll pull up the line chart for Amazon in a moment and talk about that company. I know Amazon is sort of doing pretty well outside of its retail business. What's your forward thinking on Amazon?
Yeah, Amazon is a stock that we own, ranks a 9 out of 10 fundamentally. Even in actually that pullback we saw in Amazon in April, we added to our position. I think that people think of Amazon, they often picture Amazon as at their doorstep, right? But really the real story that is expanding Amazon is how the company keeps really reinventing itself across sectors. So their logistics network is now so efficient. They're delivering to more than 60% of U.S. consumers the same day or next day. Even when I was at my cottage all summer, I was able to get, a more remote destination, sometimes next day delivery on goods. So they're doing it profitability with over $69 billion in annual operating income. And then the AWS, the cloud business, is starting to pick up again. Growth reaccelerated to 18%, which is great. And the AI demand surges. So again, I think they're using AI and robotics to make operations faster and leaner. I think one of the most overlooked stories is also in their advertising. Their ad business grew 23% last quarter, and more people are streaming sports, Prime Video, etc. Amazon is a clear runway. So again, I like this stock. I would continue to add if I didn't own this stock at the levels that it's trading at now. And it's definitely a long-term hold for us at this time.
I definitely forget about the streaming service for some reason when I'm thinking about Amazon, but they do have that package in as well. Brianne, sticking around to take more of your questions in just a moment. Stay tuned. Welcome back. Thanks for joining us on Market Call. Ghulam is on the line in Toronto. She's got a question for Brianne Gardner. Hi, Ghulam.
Hi, good afternoon. My question is on TELUS Corporation. I had some holdings in Bell Canada, but you know what's happened to the stock. The dividend was halved and the stock price is down about 20% from the price I paid for it. I was thinking of putting some money into TELUS now. I wonder if the dividend is safe and if it's going to have the same fate as Bell Canada, or should I buy it at the current price? And if you can squeeze in my other choice, which is I don't mind, just a yes or no, do you like that stock? I'd appreciate your opinion. Thank you.
So a lot to unpack. First, I want to talk to Brianne about the telecommunications space. Reminder that BCE is the parent company of this channel under the Bell Media brand. And yes, the stock, they had a dividend cut, which was part of the earlier part of the year. What are your thoughts on the telecommunications space in general right now?
Yeah, TELUS is a stock that we do own. I think the telecommunications sector overall, or the communications sector, has, had a little bit of struggling lately, rebranding, cutting back. But I do see TELUS as one that we are continuously bullish on at this time. Ranks a 9 out of 10 from a value. They did announce a partnership really to monetize its wireless tower infrastructure. They sold a stake for over $1 billion in Tyrion. I believe they submitted a proposal to acquire also the full ownership of TELUS Digital. And we saw their Q2 earnings reaffirm guidance. So for us, stable cash flow company. It's not going to be a stock that you're ever going to be like super excited about the growth or the upside potential, but you're still going to get, again, over 7% dividend yield right now, strong brand, diversified growth in health and the digital service space. One weakness is the heavy debt load that we are watching, and still the regulatory changes and margin pressures in the core telecom space. I do think that TELUS pays one of the highest dividends in the Canadian market, which is a key reason to remain as a core holdings. We are not worried about the dividend being cut at this time.
They're at about 7.5, you think, for the dividend?
Yes, and I believe, with rates now easing, I also think that telecoms should see some relief, a little bit of a relief rally, let's say, on financing costs. And their growth will likely remain modest again compared to some of the faster moving sectors like tech, but still a staple that is collecting great dividend yields for income producers or income needs, retirees, great company that we still see upside for.
Okay, that is on TELUS. Let's move on to Bally, who's calling from Newmarket, Ontario, with a question. Hi, what's your question today?
Hi, Brianne. It's a pleasure to have you here. My question is regarding Celestica. I've been buying it for quite some time, and with the current market and the focus on AI, could you help us? What's the long-term target for Celestica? Is this a buy right now? Thank you.
Okay, we'll pull up Celestica and have a look at that. Do you own Celestica, Brianne?
No, it's not a stock we own, but certainly watching closely, I will say. It is on our watch list. Canadian electronics manufacturer that builds hardware for aerospace, healthcare, telcos, and again, increasingly, as the viewer mentioned, in the AI space. So it has become a quiet beneficiary of this AI build out, with its cloud and connectivity division, supplying kind of those hyperscalers expanding their data centers. So for us, we see about 6% upside from here on the stock, value at 2 out of 10. Again, I would look for a little bit of a pullback from an entry standpoint, but if you are a holder, I'd continue to hold it. Fundamentally ranks an 8 out of 10. And the company has been growing their earnings and margins while returning capital to shareholders through buybacks, which is positive to see. The only caution, again, as I mentioned, is valuation right now. I think the stock has rallied strongly on the AI optimism, and some of that momentum may already be priced in. So we would be a little bit patient from an entry point.
Good to know. Let's move on to Kelly from Edmonton with a question. Kelly, what's your question today for Brianne? Kelly, are you there? Okay, so I think we might have lost her, but I think you had a question, Brianne, about Pan American Silver. Where do you stand on the metal?
Yeah, I think, we still are bullish on metals overall, copper, silver, and especially gold. I think Pan America Silver is not how we don't own it in the portfolio. We own, we talked about earlier, we own precious metals and ABX as a different way to get exposure in that kind of materials sector and precious metals and mining. But they are still one of the largest silver producers and headquartered actually out of Vancouver. So they operate mines across Canada, Mexico, Peru, Argentina, Brazil, etc., and have become a global leader in that silver mining. We have seen, continued strong production and growth in both silver and gold after that Yamana gold asset acquisition, and recent earnings report highlighted increased output and expansion in their Latin America business. So they're still large, diverse mining portfolio, a little bit sensitive to obviously commodity price swings or any changes there. But I think their expansion and new technology for mine efficiency, we see that likely to stay highly correlated to that sector. And one way that we like is just that ABX for the mining and wheat and precious metals for kind of a lower risk play in the space.
Okay, that is all the time we have for phone calls and emails for Brianne, but don't go away. She'll share her new top picks in a moment. Stay tuned. Join us tomorrow for Market Call. Dennis DeSilva will be on the show. He's Senior Portfolio Manager at Middlefield Limited. He'll take your questions on resource stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for new topics from Brianne Gardner. We will start with Gildan Activewear, a pretty well-known Canadian-based company that also, did it acquire, it recently acquired, right, its building?
Yes, it did. Yeah. And they have been, I would say, a quiet leader in items that like basic t-shirts, socks, underwear, as you know, low cost, vertically integrated supply chain that really gives it the company a real edge, especially when the consumer are looking for value. The company's sustainable growth strategy is all about focusing on simplifying their products, optimizing their factories, and keeping prices sharp. That discipline, we believe, has expanded their margins while their rivals have struggled. I think in today's really tough retail environment, Gildan is a more defensive play. Their middle-income shoppers are trading down, and Gildan is positioned to benefit with dependable, affordable apparel. I do think, yes, the supply chain is its moat. And we do see, assembly in Caribbean. Gildan can sidestep some of this trade risk in Asia and deliver consistently over the long run. They're at 16 times forward earnings. The stock looks fairly valued to us, broke to new highs and strong technical uptrend, and execution is solid. So 9 out of 10 fundamental for us, and we see about 16% upside from here to that around $92 price target.
Interesting. Okay, so Gildan, one to watch. Let's go to your next pick. Element Fleet, which is based in Toronto, and they do fleet management. Give me an idea a bit more of what they do.
Yeah. They are one of the world's largest fleet managers. This is helping companies really keep their vehicles on the road. So that's from financing to maintenance, really across North America, Australia, and Mexico. The company just delivered another solid quarter. We saw them showing steady earnings, strong cash flow, and really management even buying back shares to reward investors, which is obviously positive to see. And really what I think is exciting is how they're broadening the business. They're moving into smaller fleets and launching Element Mobility, which is a new platform that uses partnerships in AI and telematics to make fleet management smarter. So they are tapping into that space, and management is also being tactical. They're holding off on some new asset sales until new tax rules take effect, which could boost their revenue once that's in place. They have rising dividend, expanding services, and clear opportunities to take margins moving higher. So we continue to see Element as a steady compounder in this sector that often flies under the radar. I think you've also seen a little bit of a pullback in the stock recently, and looks like, a little oversold on the RSI from a technical standpoint. So a little bit favorable entry point too. We see about 17 or almost 20% upside from here, looking at a price target of about $42.
Yeah, it hit 38.01 in sort of the 19th of September, so mid-September, and then it's gone off a little bit down to 35. But it had a pretty good run from that April low. Everybody else sort of came back, but it's come back and gone beyond. Was there any specific reason for that you saw?
Yeah, you see the 3 month, the stock's up 8%, 6 months up 26, 12 months up 29. I think the stock has done very well, and they have, I think they did a private debt offering that could have seen a little bit of boost there as well. And they participated in kind of a lot of that offering too. And I think the buyback too helped to boost the stock there. So again, a stock that we continue to hold and see more upside for in that consumer or in the financial space there.
Okay, let's get to your third pick then, which is Honeywell on the NASDAQ, HON, which does also have its hands in almost a number of different things, defense, energy, infrastructure, and you think there's some growth here? Is that where you're looking at it?
Yeah, we try and find a few different stocks in different sectors. In the industrial, I would say powerhouse space. You haven't seen it perform as well as the market, but they have AI exposure in that aerospace automation and kind of the advanced materials. And we see it as a major software contractor for U.S. defense, energy, and infrastructure. So their suite AI kind of enabled cybersecurity solutions will certainly help companies reduce risk to industrial environments. The recent price pullback below kind of its 200-day moving average has typically been a great entry point over the long run, and the stock is still trending higher on a long-term upward chart. So ranks an 8 out of 10 fundamentally for us. Upside potential over 20%. We're looking at a price target of kind of that 254 per share. And again, I think you haven't seen the turnaround yet. So it looks like it's a little bit oversold for us, and we're hoping to catch that momentum on the upside there.
All right. And as you mentioned, it's off a little right now, so it might be a good time to pick up if you are considering it. Brianne Gardner, our guest today for Market Call. Brianne, thanks so much. We'll see you again soon.
Thank you for having me, as always, Marilla.
And thanks for watching us on Market Call. We'll see you again tomorrow.